Thank you, Cubillas. Well, we can't talk about a derivatives pricing and valuation infrastructure without talking about financial analytics, because financial analytics are going to be the core of any pricing or valuation infrastructure for OTC derivatives. Before I talk about where we are today and where the financial analytics industry is today, I just want to take a moment and go back to the beginning. The modern over-the-counter derivatives market wouldn't be possible without first financial analytics and, of course, widely available and inexpensive computing power. When Fisher Black and Myron Scholes released their paper on option pricing in 1973, that was regarded as a seminal moment, but the OTC markets really didn't get going until the 1980s, and it was because of that absence of inexpensive computing power. Back then, back in the early 80s, really financial engineering knowledge existed only in the heads of a few people at a handful of firms like Bankers Trust and Salomon Brothers in New York, and O'Connor and a couple of others in Chicago. And those firms and others like them had a competitive advantage due to their superior financial engineering knowledge. And at first, they made a lot of money trading against others who didn't have that knowledge or the technology. Of course, back then, all financial analytics were proprietary, and they were all built in-house by those most knowledgeable banks. But gradually, in the late 1980s and early 1990s, that knowledge started to leak out of those early innovative banks, and a lot of other firms replicated or tried to replicate what those pioneering firms had done. And that included building their own analytics in-house. Of course, that left the customers of the banks as the have-not. They responded by beginning to build their own tools in the case of the largest and most sophisticated firms, but a lot of smaller players that didn't have either the necessary knowledge or the economic justification to build their own software really had no solution. To meet that need, a bunch of small companies entered the analytical software market with products and services, and these firms were located primarily in New York or London. One exception was us, FINCAD. We started 20 years ago in Vancouver, and we've remained there. We started, like all the others, as a very small company. Some of these firms became successful, like FINCAD, and grew. Many fell by the wayside or were absorbed into other larger firms. Well, since those early days, the market and financial analytics have obviously come a long way. So first of all, on the vendor side, today there are a small number of globally recognized analytics vendors that have emerged. Some, like FINCAD, have been around for years, and we've demonstrated the stability to give a growing number of market players the confidence to start buying analytical software instead of building it. At the same time, buyers are realizing that most transactions are not being done with proprietary methods. So there's a growing awareness that for any financial product that doesn't use proprietary methods, there's just no justification for the extra expense involved in building proprietary analytics to do non-proprietary things. It just can't be justified any longer. And among senior executives in the bank, there's a growing awareness that it doesn't make sense to use their most expensive talent to create tools and analytics when these can be easily acquired. I think over the last couple of years, this misuse of resources is becoming much more obvious, particularly as margins narrow and there's more focus on profitability. What's just beginning to be recognized is that current in-house analytics are costing banks much more than they even realize, and that's primarily due to duplication and lack of consistency across desks and departments. So now, as I said, there are a small number of well-established vendors. The maturity of those vendors and the quality products that are now available have given organizations more confidence because commercial products offer, first of all, standardization, and many of them also provide methods for straightforward integration. So there really is no longer any barrier to using third-party technology. The bottom line is it's more cost-effective and efficient and offers faster time to market. And the products are being built by software companies. So therefore, in many cases, there's much more rigor being applied from the design stage through coding and testing, because software vendors aren't under the same pressure to respond to an opportunity in the financial markets. And that gives them time to build industrial strength solutions. Companies like FINCAD work from a multi-year roadmap, not some 1 week or 14-day time horizon. Leading companies like FINCAD have much larger user bases than in-house software builders, so any deficiencies in the software are identified much earlier because they're much more widely used. So using third-party software frees up the smartest people in a bank or an asset management firm to work on higher value areas such as leading-edge financial products or improving risk management processes, something that there's very strong focus on these days. Using third-party analytics is also the only way to bring normalization economically, because if banks try to do it themselves, they'd in essence have to set up their own software company. So in summary, as Cubillas has pointed out in his study, building analytical software is expensive, and up until now, doing it has appeared to be lucrative because of the money that's been generated in the dealing businesses, and therefore there really hasn't been any attention paid to what it's costing. But tightening margins are resulting in more efforts to create efficiencies and to cut costs. This effort, in combination with the maturity of the analytics market and the maturity of the vendors in the industry, has seen more and more leading financial firms using third-party software to address their needs. We believe that trend will strengthen in the future. So thank you for your attention, and thank you for listening.
Thanks, Bob. You know, I think sometimes people forget just how far we've come, and you know, I'm talking about from a financial markets perspective, but also from a software perspective. I'd also like to thank Cubillas for sharing the results of the Celent's recent study, and I'm sure that that information has certainly opened the eyes of decision makers who are sort of in that debate about in-house development versus bringing in third-party solutions. Now, if anybody would like a copy of the Celent research report, or if you'd like additional information on FINCAD solutions, please feel free to contact us. You know, here are a few different ways that you can contact us: by phone, email, or of course the website. And thanks for watching.